What if I told you that most investors are making investing far more complicated than it needs to be? You can build serious wealth with just 3 ETFs. 3, not 30 stocks, just 3 ETFs. And that's important because most people aren't professional investors. They don't have time to research hundreds of companies or figure out which stock is going to win next. They have careers, families, businesses, lives. And if you're trying to pick the next Amazon or Nvidia, you're already making investing harder than it needs to be. Because building wealth isn't about finding the next winning stock. It's about owning great businesses, staying invested, and letting time do the heavy lifting. So let's take the guesswork out of it. If I were starting over today, here's exactly how I'd build that portfolio. I'll show you the actual ETFs I would use, the role each one plays, and how I would adjust the portfolio, whether you're 25, 45, or already approaching retirement. You'll see the exact allocations I would use at different stages of life and how one optional position can be used to customize the portfolio for your own goals and risk tolerance. Ready? Let's get into it. First up, what does the portfolio actually look like? At its core, it's built around 3 ETFs. Each one has a specific job. And together, they create a portfolio designed to grow with you through every stage of life. The first ETF is your foundation. This is the bedrock of the portfolio. The piece designed to give you broad exposure to the American economy and some of the world's most successful companies. The second ETF is your income and stability engine. Its job is to generate cash flow, provide resilience during market volatility, and help smooth out the ride when growth stocks inevitably hit turbulence. And the third ETF is your Growth Accelerator. This is where we lean into innovation, technology, and the companies driving future economic growth. Together, these 3 ETFs create a simple but powerful framework, a foundation for stability, an income engine for resilience, and a growth engine for long-term wealth creation. But here's where things get interesting. Most investors stop there. I don't. Because investing isn't one size fits all. A 25-year-old building wealth has very different needs than someone preparing for retirement, which is why I include what I call the flex position. This isn't a required 4th ETF. It's an optional position that allows you to customize the portfolio based on your goals, stage of life, and risk tolerance. For some investors, that might be international exposure. For others, it might be individual stocks. While some of you may prefer cash, bonds, or even a small allocation to alternative assets like crypto, commodities, or REITs. The core 3 stay remarkably consistent. The flex position adapts as your life changes. That's what makes this framework so powerful. Simple enough for a beginner, flexible enough for an experienced investor, and designed to evolve with you over decades, not months. Now, a portfolio is only as strong as the investments inside it. So let's take a closer look at each ETF, the role it plays, and why it earned a place in this portfolio. But before we do, if you're finding this helpful so far, do me a quick favor and hit the like button. It helps the channel tremendously and tells YouTube to show this video to more people who are trying to learn how to invest and build wealth. All right, let's reveal ETF number 1 and break down why it's the foundation of this entire portfolio. Every great building starts with a strong foundation, and investing is no different. If this portfolio were a house, the foundation ETF would be the concrete slab everything else sits on. Its job isn't to be the star of the show. Its job is to provide broad exposure to the American economy and create a stable base for long-term wealth creation. For me, that ETF is VOO. VOO is Vanguard's S&P 500 ETF. When you buy a single share of VOO, you're not buying one company. You're buying ownership in approximately 500 of the largest publicly traded companies in the United States. Companies like Apple, Microsoft, Amazon, Nvidia, JP Morgan Chase, Visa, Costco, and hundreds more. In other words, you're not betting on a single company. You're betting on American business. Over time, companies come and go. Leaders rise and fall. But the index adapts. As weaker companies drop out, stronger companies take their place, which means you're constantly invested in many of the largest and most successful businesses in the country. And that's really the beauty of index investing. You're not buying ticker symbols, you're buying ownership. Now, some investors prefer VTI, which owns virtually the entire US stock market, and that's a perfectly reasonable choice. But for me, VOO strikes the right balance. It gives me exposure to America's largest, most established companies while remaining incredibly simple, low cost, and easy to understand. That's why VOO serves as the foundation of this portfolio. It provides diversification, long-term growth, and exposure to some of the most profitable businesses ever created. But a foundation alone isn't enough. We also need something that can generate income, provide resilience during market volatility, and help smooth out the ride. That's where ETF number 2 comes in. If VOO is the foundation of the portfolio, then ETF number 2 is the shock absorber. Because investing sounds easy when the market is going up. It's much harder when your portfolio drops 20, 30, or even 40%. That's when investors panic, when they abandon their strategy, and that's when long-term wealth-building plans fall apart. That's why the second ETF in my portfolio is SCHD. Now, SCHD is often called a dividend ETF, and while that's true, I think that description misses the bigger picture. SCHD isn't just about dividends, it's about quality cash flow, and it's about owning businesses that have already proven they know how to generate profits through good markets and bad ones. Companies like Coca-Cola, United Health, Verizon, Texas Instruments, businesses operating in completely different industries, but all sharing two important traits: consistent profitability and a long history of returning cash to shareholders. While growth ETFs focus on tomorrow's innovators, SCHD focuses on companies generating substantial profits today, companies that pay shareholders to own them. And that brings me to one of the biggest mindset shifts investors need to make. Wealth isn't just about what you own, it's also about what your assets pay you. Think about it this way. Most people spend their entire lives working for money. But truly, wealthy people eventually reach a point where their money starts working for them. That's where dividends come in. When companies inside SCHD generate profits, a portion of those profits is distributed to shareholders in the form of dividend payments. And if you're reinvesting those dividends, you're using those payments to buy even more shares, which then generate even more dividends, which buy even more shares. It's one of the simplest examples of compounding in action. Now, traditionally, many investors use bonds as the stability portion of their portfolio. And for some investors, particularly those in retirement, bonds may still have a role to play. But for investors who are still building wealth, I prefer SCHD because it gives me the opportunity to generate income while still participating in long-term market growth. In other words, I don't have to choose between growth and cash flow. I can have both. That's why SCHD serves as the income and stability engine of this portfolio. VOO helps me own America. SCHD helps me get paid while I do it. So far, we've built a strong foundation. VOO gives us broad exposure to the American economy. SCHD provides income, quality, and resilience. But if we're still in wealth building mode, we need one more thing: Growth. That's where ETF number 3 comes in. For me, that ETF is SCHG. SCHG is a growth-focused ETF designed to give investors greater exposure to companies that are growing faster than the broader market. Think companies leading innovation, technology, artificial intelligence, healthcare breakthroughs, digital infrastructure, and the industries helping shape the future economy. Now, this isn't about chasing hype. It's not about trying to predict the next big thing. And it's certainly not about gambling on a handful of speculative stocks. It's about recognizing a simple reality. Throughout history, innovation has been one of the most powerful drivers of wealth creation. The companies that solve problems, increase productivity, and change the way we live and work often create tremendous value over time. SCHG gives us additional exposure to those businesses, and that's why I call it the Growth Accelerator. VOO already gives us growth, but SCHG allows us to lean a little harder into the areas of the market that have historically driven much of that growth. Think of it this way. VOO is the engine. SCHD helps smooth out the ride, while SCHG presses a little harder on the accelerator. Not because we're trying to get rich overnight, but because we're still building wealth. And when you have decades ahead of you, growth matters a lot. Now, could you use a different growth ETF? Absolutely. Some investors prefer QQQM, others prefer VUG. All three can serve a similar role inside the portfolio. The specific ETF matters less than the purpose it serves. And that purpose is simple: to increase your exposure to long-term growth. So now we have our 3 core positions: a foundation, an income and stability engine, and a growth accelerator. But investing isn't one size fits all. A great portfolio isn't just about what you own. It's also about how you put the pieces together. Because a portfolio designed for a 25-year-old should look very different from one designed for someone approaching retirement. So let's talk about allocation. Now that we understand the 3 core ETFs, the next question is, how much of each should you own? And the answer depends on one thing: time. More specifically, how much time you have before you'll need this money. Because a 25-year-old investing for retirement has very different needs than someone planning to retire in 5 years. That's why I don't believe in one-size-fits-all portfolios. The core 3 remain remarkably consistent, but the percentages change as your life changes. And before we talk about those percentages, there's one final piece of the framework you need to understand: the flex position. Most portfolios fail because investors keep adding things: more ETFs, more funds, more complexity. The flex position isn't an excuse to do that. It's a way to customize the portfolio without breaking it. Here are the 3 rules. Rule number 1, the core 3 stay intact: VOO, SCHD, and SCHG. Rule number 2, the flex position solves a specific need, not a random idea, not a hot stock tip, not something you saw on social media. A specific need: international diversification, additional income, capital preservation, or a small allocation to a higher risk opportunity. Rule number 3, the flex position stays relatively small. Because the goal isn't to reinvent the portfolio, it's to personalize it. The core 3 build wealth. The flex position fine-tunes the strategy. Now let's look at how I would allocate this portfolio at different stages of life. But before we jump into those allocations, if you're finding this video helpful so far, I'd really appreciate your support. Hit the like button, subscribe if you haven't already, and if you think this video deserves it, tap hype as well. Every one of these helps YouTube share this video with more people who are trying to learn how to invest and build wealth. Retirement isn't an age, it's a strategy. Because I've met people who were financially independent at 40, and I've met people still working at 75. The calendar doesn't determine retirement. Your finances do. Retirement begins the moment your paycheck stops and your portfolio takes over. That's the real transition. And when that happens, the purpose of your portfolio changes. For decades, your investments were helping you build wealth. Now they're helping support your lifestyle. That's why one of the biggest myths about retirement is that you stop investing. You don't. Your portfolio still has a job. The mission simply changes. Instead of maximizing growth, you're now focused on income, stability, preserving purchasing power, and keeping pace with inflation. Because retirement isn't the end of investing, it's simply a new phase of it. And regardless of whether you retire at 40, 60, or 67, one principle remains the same. You need a plan for market downturns, because markets can and will decline, sometimes for months, sometimes for years, and the last thing you want is to be forced to sell investments at the exact moment they're down. That's why I believe every retiree should have a financial airbag. 3 years of living expenses held completely outside the market, money market funds, high-yield savings accounts, short-term CDs, safe, accessible, and ready when you need it. Think of it as your retirement runway. When markets get turbulent, this cash buffer gives your portfolio time to recover without forcing you to sell investments at a loss. Because the goal isn't just to retire, it's to stay retired. Let's look at 3 examples and see how that strategy changes depending on when retirement begins. But first, if you're enjoying the video, I'd really appreciate it if you'd hit the like button, tap hype, and subscribe. Every one of those helps the channel grow and allows me to keep creating content like this. All right, let's put all of this into practice. We'll start with the most traditional retirement scenario. You're 67 years old, you've finished your career, Social Security has begun, and now your portfolio is helping support your lifestyle. Let's assume you've accumulated a retirement portfolio of roughly $1.5 million. And let's say your annual spending goal is around $70,000 per year. Social Security may cover part of that. Maybe $20,000, maybe $30,000. The exact number isn't important. The point is that your portfolio no longer needs to do all the heavy lifting by itself. Let's put some numbers to that. Say Social Security covers about $24,000 a year. That means your portfolio only needs to reliably provide the remaining $46,000. Now remember the financial airbag or emergency fund we talked about earlier? This is where it becomes incredibly valuable. Think of it as 3 years' worth of living expenses sitting safely on the sidelines. In this example, that works out to roughly $140,000 held outside the market. Money market funds, high-yield savings accounts, or short-term CDs. Why? Because markets don't move in straight lines. Some years will be fantastic, others won't. And the last thing you want is to be forced to sell investments during a downturn just to cover living expenses. Let's say the rest of your portfolio, about $1.36 million, is still invested. Then, after enduring a year or two of down markets, the tide finally turns. Because eventually, markets recover. They always have. If your remaining $1.36 million portfolio grows by 15%, that's more than $200,000 in gains. You could withdraw your $46,000 for the year, rebuild your financial airbag, and still finish the year more than $100,000 ahead. That cash reserve gives your portfolio time to recover. It gives you flexibility. And perhaps most importantly, it gives you peace of mind. The rest of the portfolio can remain invested and continue working for you. Here's how I'd structure it. 40% VOO, 50% SCHDs, 10% SCHG, plus 3 years of living expenses held outside the market. Notice that growth hasn't disappeared. It's simply no longer the priority. Income and stability now take the lead. And if you've been funding an HSA throughout your working years, this is exactly the stage it was designed for. Those tax-free dollars can now help cover healthcare expenses without placing additional pressure on the rest of your retirement portfolio. Because at this stage, the goal isn't to maximize returns. The goal is to generate reliable income, preserve purchasing power, and maintain the lifestyle you've spent decades building. Remember, you don't retire from investing. You retire into a different investing strategy. Now, let's look at a different situation. What if you retire at 60? You're no longer working, but Social Security hasn't started yet. That changes the math. Because now your portfolio may need to cover your entire living expenses for several years before those benefits begin. If you've been contributing to an HSA throughout your working years, this is where that planning begins to pay off. And that's also why I still believe the financial airbag becomes critical. 3 years' worth of living expenses held somewhere safe and accessible gives your portfolio time to recover during market downturns without forcing you to sell investments at the worst possible moment. In this example, your portfolio now needs to provide the full $70,000 each year, while your financial airbag grows to approximately $210,000, enough to cover 3 years of living expenses outside the market. If you haven't built up your emergency fund up until this point, that leaves about $1.29 million still invested. Now imagine, after a 2-year downturn, the market rebounds by 15%. Your remaining portfolio grows by roughly $193,000. Of course, not every year will look like this, but that's not the point. The point is that you've given yourself time. Time to let your investments recover. Time to avoid selling during market downturns. And time to continue compounding while you wait for Social Security to begin. Unlike our 67-year-old retiree, though, you still have a much longer runway ahead of you. Social Security may still be 5, 6, or even 7 years away, and retirement itself could last 30 years or more. That means growth still matters. In fact, it matters more than people realize. Because inflation doesn't retire when you do. Your expenses will continue to rise. Healthcare costs will continue to rise. And your portfolio needs to keep up. That's why I would structure the portfolio like this: 40% VOO, 45% S, CHD, 15% S, CHG, plus 3 years' worth of living expenses held outside the market. Notice that the Growth Accelerator receives a slightly larger allocation than in the traditional retirement example. That's intentional. We're trying to strike a balance. Enough income and stability to support today's lifestyle. Enough growth to help support tomorrow's. Because retiring at 60 isn't the same as retiring at 67. Your portfolio may need to carry more of the load for a longer period of time. That's why this stage isn't about becoming more aggressive. And it isn't about becoming more conservative. It's about becoming more intentional. The goal is to create a portfolio that can continue generating income today while still growing enough to support you decades into the future. Because retirement isn't just about leaving work. It's about making sure your money can continue working long after you do.